This conference will now be recorded.
As we move into the second half of this semester, we're going to be looking at a lot more business type items that an individual may own themselves, like their sole proprietorship or potentially a rental business. But today we're going to start off the second part of the semester with looking at retirement accounts that a business can offer, but you can also get for your individual. So that includes things like a 401k. Those are for usually some bigger companies. And then for smaller companies, they may offer their employees what's called a simple plan. Then we're going to move into what is an IRA and a Roth IRA, and what are some of the limits of when you can and can't use an IRA. We are going to look at when can you take out money for a retirement account, and when do you have to start taking money out. And then we're going to finish up by looking at what's called an annuity, where you potentially could receive payments over time or for life. And then how is that deemed to be taxable? How do we know when it's taxable and when it's not? So some of the benefits of putting money aside for a retirement plan is, for federal purposes, as the employee, when you put money aside, you're not taxed on that money right away for federal purposes. Now, that's not the same for when you talk about FICA purposes. If you've already had payroll, accounting 106, then you should already be aware of this. For tax purposes, when you put money aside into a retirement account, you are not taxed federally. You're only taxed federally when you take it back out, as well as on the earnings when you retire. So let me show you what I mean by that with this little example. If I have $40,000 in gross wages, and if I didn't do anything else, that would be what's on my W-2, and that's what I would be taxed on. However, I decided to put $4,000 away into a retirement account this year. Now that $4,000, we're going to come back to that in just a minute. But I put $4,000 away, and even if my employer matches, that's great for my retirement account, but it doesn't show up anywhere in my current taxes. I'm not going to see that on my W-2. It's not going to be taxable to me in any way at the moment. It'll only be taxable when I start taking the money out. So the part that the employer matches, that's just gravy right now. It doesn't matter for purposes when preparing a tax return. Now, it would matter from the employer's standpoint, but not the employee. Now, for the $4,000, how that's going to end up, when we have it on our W-2, that $4,000 is going to be taken off of the $40,000. So we're not taxed on that $4,000. We're only taxed like we made $36,000. However, for FICA purposes, for Social Security and Medicare, we will continue to be taxed on that $4,000. And that's why box 3 and 5 on our W-2 will still be at $40,000. And we're going to be taxed at their percentages like we made $40,000. The good news then is when you retire and you take the money out, then you don't pay the FICA taxes again. But unfortunately, you are paying it up front. So as I said, putting away money is a good thing. It not only helps your tax situation now, but if you look at this, if I put $4,000 away every year, and I start early in my career at age 25, and I put money away for 40 years, now that $4,000, that's just me putting it in by myself. If my employer would match, then I would only need to put away $2,000. So basically what I'm saying is if somehow you get $4,000 put into your account, and on average you can earn 6% interest on that $4,000 annually. When you do this, looking at the time value of money tables, and if you've had me for Accounting 101, you'd be somewhat familiar with this. When you do the work, it comes out to be $1.4 million in your account by the time you're age 65. Whereas if you only put the $4,000, say, aside and just kept it safe, and you wanted to see how much you would have in retirement, if you just put $4,000 away, you would and not earn any interest, you're only going to have $160,000 compared to $1.4 million after 40 years. So putting the money away is such a huge component. You really should take advantage of that. At least trying to put away $2,000, and if your employer would match it, another $2,000. Got some drawbacks here that you may want to read through. Most popular retirement plans, we're going to go through these, and we're going to start with the 401k, which is the same as a 403b. They're just simply named differently because one, 401k is for for-profit companies, 403bs are for not-for-profit or government entities, so schools, government agencies, they're going to be over here in the 403b. 401k is going to be your normal for-profit companies. Now, the good and the bad. A lot of times the employer will put money into your 401k, and then you also put in, maybe your employer will match up to a certain point. You can put in total between you and the employer up to $54,000. Remember that number as we keep going. Now you individually, you can put away up to $18,500. Now that's a lot of money for most of us. Now, if you make a lot of money, say 100,000, 200,000, maybe that's not so much. But for most of us, putting away that much, we'll never hit that. But you could. Now I want you to remember that number as well, this 18,000, compared to some of the plans later, that they're definitely less. This is by far the best plan if you can afford it to put money away. And notice how much you can also put away if you're over 50. You can put in an additional 6,000. So you could put away 24,500 into your 401k. Now, the good and the bad with a 401k. The good is basically once the employer gives you the money, it's your money. And you put your own money aside, that's your money. You have control over how the account's going to be invested to an extent, especially while you're still working there. However, the bad is when you retire or you start taking the money out whenever, once those funds are gone, you're done. You don't have that safety net like you would as we talk about a pension coming up, or as you would with Social Security. Social Security, once you hit a certain age, and as long as you've put in enough money, and it's not that much, you can get Social Security for life. It doesn't run out for you individually. So that's kind of the bad side. Once you use it, it's gone. So the risk, well, in this case, with a 401k, the risk is on the employee. Now, another kind of good thing then is the employee does die early, that money stays in the family or it stays with the beneficiary, and then they get to keep the money. So yeah, it's a risk, but you also get a reward if you don't use it all. The money just continues to flow on through heirs. Now, kind of compare a 401k to a simple plan. Notice a simple plan is for smaller employees. It's less paperwork to fill out, so it makes it easier on the employer. And there's just a few rules. The employees must be eligible to participate. You can read through some of that, but it's not that. The only other major rule is this one. The employer will choose which option they want to do for the simple plan. They can say, we're going to do this option, and we're going to match up to 3% of whatever you put in. Or perhaps they think 3% is too high. The other option they can choose is, we'll contribute 2%, but we're going to do it to everybody's salary. So yeah, we're going to give less, but we give it to everybody. Whereas with this one, they give more, but they only give it to those who help themselves and put money in themselves. Now, remember up above, the contribution limit was $18,500. Notice this one is smaller, $12,500. Now, it's still a lot of money, but it begins to limit. It begins to go down, and we're going to see that continue. Now, there is a catch-up period if you're over 50, and notice this dollar amount is half of what it was for the 401k. So it's not as lucrative as a plan, especially for the high income. Now, compare those two, which are called a defined contribution plan, to this, which is a defined benefit plan. Defined benefit plans are pensions. Pensions are going out of style. A lot of companies don't want to have that saddled debt with them for the rest of their employees' life. Because basically with a pension, in a sense, the employee is guaranteed a certain amount of income throughout their retirement. Now, that doesn't always happen, especially when companies file for bankruptcy like Enron or WorldCom. A lot of those employees will lose out and maybe not get anything at all. It all kind of depends on a lot of situations. GM was another example where they didn't quit their payments, but they did lower them to be able to stay viable. So with the pension plan, some of the good and the bad, basically the employer puts money aside and they allocate the funds and invest it how they think it's best. A lot of times a company will have to have an outside insurance type company do it for them, because by state law they're not allowed to unless they're of such a large company that they can handle the amount of potential payouts that'll have to come years and years down the road. They'll have to have a professional company that only works with that. So the good and the bad here, the bad is the employee has no control. So if the company does go bankrupt or spends the money that it's not supposed to, they could be out of luck. The good is, as long as the company does what they're supposed to do, you're going to get paid that certain amount, or you should, if everything goes right, for your entire life. And you don't have to worry about running out of money. So the burden is kind of on the employer, and it all depends on how long the employee lives and or their spouse, if their spouse is also covered. Okay, let's step back now from the company side and look at, well, what if I don't have an option at work, or I want to put my own money away? You can do that with the IRA. The IRA, if you don't have any plan at work, or maybe you have your own job, you have your own company and you don't have a retirement plan set up, you can have an IRA and anybody can put money in, no limits. No, I should say no income limits. There is a limit on how much you can put in. We'll look at that here. But if you have no other plan, then you are not subject to any phase outs. You can put in the full amount. If you do have an income plan through other companies, through the company that you may work with, then there are income limitations, and you can only invest into an IRA if you meet the certain guidelines. All right, so the general rules for anybody, for everybody, you can contribute up to $5,500 a year. Now compare that to the simple plan, which was $12,500, and then the 401k, which was $18,500. This one's not nearly as beneficial or lucrative to the person. You can put in $5,500 or 100% of your salary, so that would make sense. You obviously wouldn't put in more than you make. You can also put in for your spouse. So even if your spouse doesn't work, that's okay, as long as the one spouse makes over $11,000. They can both put in $5,500 for the two in a married situation. You got to have earned income to put money away. Obviously, you got to have this salary piece. If you're 50 years older, notice it's not definitely as good as the 401k or the simple plan. You can only catch up $1,000 a year, so that puts you up to $6,500 a year, and that's for those 50 or older. These deductions, if you do this plan, this is something you do on the side. Your employer probably has no idea that you're doing it. So therefore, on your W-2, your boxes 1, 3, and 5 will be the same for almost everybody. Say you had that $40,000 example. Your boxes 1, 3, and 5 would all be the same, because the employer's not knowing that you're putting away money into an IRA. That's something you're doing on the side. So to make up for that, what the tax law allows on now your Schedule 1 on line 32, you can deduct for federal tax purposes the amount that you put away into an IRA. And it's just like you deducting it off of your box 1. You're not being taxed on that $4,000 like we had in box 1. So your AGI would end up being $36,000. Yeah, you would have put 40 as your initial W-2 amount, but then you took away 4 down here in Schedule 1, which lowered your AGI to 36, which would have been just like it would have been with if you were an employee. One odd thing with an IRA, if you find that at the end of the year when you file your taxes, you're going to end up owing a little bit, but you have the option and you have the ability and the wherewithal to make put money into an IRA, you can actually do it up and through that next year, up through April 15th, but still count it for the past year that you're doing your taxes for. So it may be March and you find out that you owe $500 in federal taxes. You could still in March put money away and count it as you putting it away in the year prior. Therefore, if you put, say, $5,000 away, that reduces your income by $5,000 and then reduces how much you owe to maybe you're even getting some back now. Now, you might think, why would I want to put $5,000 away when I only had to pay the government $500? Well, that $5,000, that's your money. It's just you're not going to see it right now. You're going to see it later on when you retire. The $500 you give to the government, well, that's going to be gone forever. You're never going to see that again. So with an IRA, your earnings are taxed when they are withdrawn, plus any earnings on top of that, the interest earnings. And you can't start taking money out until you're at least 59 and a half, but you do have to start taking out on or before the age of 70 and a half. You have to start withdrawing, and we're going to look at how much here in just a few minutes. All right, so up above, I had mentioned that if you do have a retirement plan at work, or you at least have the option, then you're not allowed to put into an IRA once you hit a certain income limit. And you can see the income limit here. This is for individuals that do have a retirement plan at work, an option. And you'll see that on the W-2 in box 13, a retirement plan will be X'd. And that tells whoever's doing the taxes or the IRS that this person would fall into this, and therefore if they're putting money into a retirement plan, they better be within these guidelines. So let's see. What this means is if your AGI is under 63,000 and you're single, then you have no limit. You can put away the full 5,500. If you're above 73,000, you can't put away anything into an IRA. In between, well, we're going to work through that and show an example of how that works. It's like in the other phase outs that we have, but we'll work through an example. Same thing with married filing joint. Notice it's not quite double. So that would be considered a marriage penalty. If there were two single people, they would have 126,000 as their low number, but compared to the 101 that's allowable right now. Notice the span here is 20,000, and over here it's only 1,000 or 10,000. Let's see how this works. If the person's AGI is 105,000, so they make pretty good money, how much can they put away and deduct for an IRA? And that's the key, is the word deduct. You can put money into a non-deductible IRA, and those are separated out differently than the deductible IRA, because with the deductible IRA, you're going to pay tax on whatever you deducted when you take it back out later on when you retire. A non-deductible IRA, that means you put money aside for retirement, but you're just not going to be taxed on it again when you withdraw because you were paying taxes on it currently. All right, the individual's 45. I had to tell you that so you would know if they get the extra amount or not. But this person wants to put away as much as they can for their age. If they are single and they make 105,000, they are over the limit. They cannot put anything into a deductible IRA. If they are married filing joint, and we're talking about just one spouse at the moment, or maybe both, if they're married filing joint and neither of them, or they both have an AGI, they're married filing joint and they both have a retirement plan option, and they make 105, which is right here in between the phase outs. What you need to do to determine how much can they deduct. How I always do it, you always start with your top number of the phase out and then subtract the AGI. And I'm going to pull up as I walk through this. So the top number of the phase out minus your AGI. So that's 16,000 out of the 20. So you're still, if you take 16 divided by 20, what that's basically saying is you can still deduct 80% because you're just barely over the cap, over that first 101,000. 16,000 divided by 20, 80%, and then 5,500 per person. So that's why I put it here on a per person or both, depending on how they wanted to do their IRA. 80% of 5,500 comes out to be $4,400 per person. That's how much they could put in and deduct on their 1040 because of the phase-out rule. Now, one other then option is, well, what if only one of a married filing joint couple, what if only one of them has a retirement plan but the other one doesn't? Are they both still bound by these rules? And the answer is no. Only the one who has the retirement plan option is bound by this rule. The other spouse who may not have a retirement plan option at their work, they get a higher AGI phase out. They can, then the phase out bumps way up to 189 to 199. And that person, the spouse that doesn't have the retirement plan, can still put money away with a much higher income. All right, so we've got married filing joint couple here. One spouse is in a plan or has the option of a plan. The other spouse doesn't. And they want to know how much can each spouse put into an IRA if they wanted to deduct the maximum. Both of them are, again, 45 years old. All right. You may want to go ahead and pause and try this one on your own for the next couple minutes, and then I'm going to explain what's going on here. All right, with this example, with somebody with 144,000, the individual that does have the retirement plan is over the 121. They can't deduct anything. The other spouse who doesn't have the plan is well under the 189, so they can deduct the full 5,500. That's how this first one would work out. One is over, one is under, so one can deduct the full amount. If they have a now income of 194, again, the spouse with the retirement plan is even further over, so they can't deduct anything. The spouse that does not have a retirement plan is inside the phase out. So you should be able to, at this point, go ahead and pause and then determine how much of the 5,500, doing the same phase out type calculation, would they be able to deduct. Okay, using the same phase out, remember we take the top number, 199, minus the AGI, so that's 5,000 left, and divide it by the span of the bottom number to the top number, so that's 10,000. They're allowed to take 5 out of 10, so 50% of the full amount of $5,500. So they would be able to deduct $2,750. Notice my last little comment here, and this is just to reiterate that point I made earlier. You may not be able to deduct if you are over those guidelines, but you can still contribute to an IRA. It's just considered a non-deductible account, as I had originally talked a few minutes ago. Some people who don't quite make the phase outs for an IRA should potentially look into a Roth IRA. A Roth IRA is slightly different in that when you put money in, you never get to deduct it off of your taxes currently. That's the bad news. The good news is, even because you don't get to deduct it, when you take the money back out, you don't pay tax on it, and you don't pay tax on any earnings. So you just take money out and it's free of tax because you paid the tax up front. So a lot of people, if they can afford it, they'll want to do the Roth IRA because you're going to pay the tax now, but later when you take it back out, no tax, and no tax on any of the earnings, which could be significant, especially if you put $4,000 away every year for the next 40 years. You put it into this Roth IRA, and then all of a sudden you got 1.4 million coming to you, and none of it will be taxed again. So you got to think about that. That could be huge. All right, same contribution limits as the regular IRA. You can put in up to $5,500 a year, so that still is under the $4,000 that I had mentioned. So you could easily get to that 1.4 million. Now you may need to put in more if you're over 25, but you have to, I could easily, or you can easily do the calculation to figure out how much do you want to have when you retire, how much do you need to put away every year. One of the stipulations with the IRA above is once you hit age 70 and a half, you can't put any more money in. With a Roth IRA, you can still put money in after the age of 70 and a half because the government doesn't really care. They're getting your tax right away. You don't get to deduct anything. You can still put money away even after the end of the year and still count it for that previous year. That's the same as the IRA. Notice the contribution, the phase out limits. It doesn't matter if you have a retirement option at work or not. It's the same as if you do or don't. And the amounts are quite a bit higher. For singles, they're almost doubled. For married filing joint, they're at that second tier where one spouse has the IRA and one spouse doesn't. Not quite double, but at least 50% more. So I don't have any examples because it's doing the same phase out, but you could work through some potential examples if you wanted to. If there was if you had an AGI of 125,000, how much could you put in to a Roth IRA? So basically, the keys to the Roth IRA is you pay taxes on all your contributions right now. You don't pay any tax later on when you take it back out, plus any earnings. All right, let's look at the rules then for the IRA. And most of these rules are the same for a 401k. There are a few exceptions where they are different, and I'll try to highlight those. So a lot of these rules are very similar to a 401k, even though I put it's not including a 401k, most of them are. This first one is the same. You can't take out money before you're age 59 and a half. If you take out money before that and it's not for a qualified purpose, then you will pay an additional 10% penalty on your entire distribution. That's in addition to the amount of tax that you would owe normally. You have to pay an extra 10%, and that goes on your tax return as an additional just penalty that you can't get back. Basically, that's the government trying to discourage you from taking money out of your retirement so you'll be able to support yourself later on in life. Now, the exceptions here, these are only for IRA individuals. These do not include 401k. The two primary ones here are if you take out money to pay for higher education, or you try to take out money for if you're a first-time home buyer and you want to put a down payment down. You can take up to $10,000 in that case. So that could be a big benefit because you're not paying extra interest. So that's why they allow that as an exception. So again, these exceptions will get rid of the penalty, but it does not get rid of the tax that you would owe. The difference then with a Roth, there is no age limit. You just simply have to have been participating in the plan for at least 5 years. After the 5 years, then you can start taking money out. If you take it out before, you're going to again have the 10% penalty. So no age limit, it's just the 5 years. So that was a penalty if you take it out too early. Now the government then shows, well, at some point we require you to start taking it out because we want to make sure we get our money. The government wasn't getting their retirement, the money that you put into retirement when you put it away because it was deductible. However, they say by the age of 70 and a half, you have to start taking money out, and therefore we get to start taxing you. So these are for all retirement plans except the Roth IRA. With a Roth IRA, the government's already got their money. You don't have to take it out. There is no required minimum distribution. The first kind of an odd rule here is, well, what about when you hit 70 and a half? When you hit 70 and a half, whatever year that is, you have to begin to withdraw by April 1st of the next year. And so I give some examples here in a second. And then, so that would be your first withdrawal would be by April 1st, say of 2019 or 2020. Let's say it's 2020. Your second withdrawal would have to be by December 31 of 2020 as well. So you're going to have 2 withdrawals within that first year as a required minimum distribution. And then you have to do one every year thereafter, depending on how much you still have in your account. And we're going to determine that here in just a few minutes. We're going to see, well, if you have to take money out, how much do you have to take out? And we're going to do that. But first, let's look at this 70.5 example. And we're going to have the birthday differentials by 1 day. And you're going to see how much a difference it makes when it happens to be this particular day. So Joe has his birthday on June 30th, and he'll be 70 this year in 2018. Therefore, he will be 70.5 on December 30th. And then the rule states you have to begin to withdraw by April 1st of the following year. So that means by 2019, April 1, just a few months later, he has to start taking money out of his account. Whereas Betty was born 1 day later, but her half birthday doesn't end up until January 1 of 2019. Therefore, she has to start withdrawing by April 1 of the following calendar year. So that's not till 2020. She gets a whole extra year just based on this sharp cutoff. I thought that's kind of interesting. All right, so now that we know when we have to take money out, how much do we have to take out? Well, that's where we're going to need the book and the tables in the back of the chapter of chapter 11. We're going to need to know, based on what the IRS says, what is kind of on the very high side. They do allow you on a high side. They don't make you take out a whole bunch right away. They do it on a very high side. What on the high side would we expect you to live at your current age? So if you look in the book on page, depending on the edition, on or around page 11-28, you're going to see table 3. And this table 3, as you can see, is for the different types of people. And then at the very bottom in the fine print, right below that, it says, generally this table is used by the owner of an IRA. So this tells basically what they're saying. If you're 70 years old, on the high side, on the pretty high side really, they're expecting you to live another 27 years. And again, they're erring on the high side, so you don't have to take out too much money right away. They're allowing you to take it out a little bit slower than perhaps your normal life expectancy. So what you have to do is you have to take your account balance, whatever is in there at the time, maybe $100,000, maybe $1 million, whatever it is, and then you look at that balance, whatever year you got to be 70.5, and you divide it by what the book says your life expectancy is at that time when you turn 70.5. All right, so let's do some examples, and then you can see the penalty. The penalty is pretty stiff if you don't follow by these. So most people do, and then if they don't want the money, they reinvest it into a Roth IRA. They put it into some municipal bonds to earn interest. There's other ways, but they do have to pay the initial tax. All right, so example B, I give us when Joe, when does he turn 70? I give that to us, and I give us his account balance as of the end of the year when he turns 70.5. We've got to determine then how much does he need to start withdrawing and how much. So using what I have up here, think through this, and then here in a few minutes we'll go through it, and then we'll see if you can do even better on example E after you've seen one of the examples. All right, with this example, Joe, he turns 70.5 on August 15th, so he has to start making a required minimum distribution by April of 2019. Now all we got to do is determine how much. At the end of the year, when his account balance is, he is still 70 years old. So what we're going to do is look at this table 3, and at the age of 70, at the end of the year, his distribution period is 27.4. So we're going to take 550, and we're going to divide that by 27.4. That tells me then, as his tax preparer, or actually this would be the retirement company, that he has to take out at least $20,000 out of his retirement account, otherwise he will be heavily penalized. And he has to do that on or before April 1st of 2019. And then he would have to take out another distribution, and we're going to see that coming up here in the second example, by December 31 of that current year. They're going to have to redo the whole calculation. What is his new balance in his account divided by his new life expectancy in that next year? Because within the next year, he's now going to be 71 by December 31. And so his distribution period now goes down to 26.5. All right, so let's look at Alice. I would read through this one and pause it, and then pause and try to do these two steps. And let's see how well you do with required minimum distribution. So with Alice, she doesn't turn 70 and a half until 2019. So therefore, she doesn't have to start taking out until 2020, April 1 of 2020. So I give us two account balances because she's earning money, so therefore her income went up, the amount of the balance. We don't care what it is as of 2018. She wasn't 70 and a half at that point. So that's extra information. I want to know this number because that's what she is in that following year. She doesn't turn 70 and a half until 2019. So therefore, she doesn't have to start taking out until April 1 of 2020. All right, so what we need to do is take 300,000, and as of 2019, she will be 71 at the end of 2019 because her birthday falls on October 15th. So October 15th of 2019, she hit 71. So we need to take 300,000 and divide it by 26.5. So therefore, she has to take out 11,321 in her first installment. All right, so then we get down to part two, and I asked us then, how much does she need to take out for her second withdrawal at the end of December? So what we need to do is figure out, okay, how much is still in her account? First thing we need to do is take the 300,000 and subtract out the 11 that was paid. So she has less than 300. But then I tell us she earns 5% on whatever's left throughout the end of the year. Okay, so let's see the work here. I took 300,000 and subtracted her initial withdrawal. So she was down to 288,769. If you tack on 5%, that's an extra 14,000, even more than she withdrew. So she's right back up to pretty much where she started, which is nice. So she's back up to 303,000. So in December, she is now 72 years old in December of 2020. Therefore, she needs to take the 303,113 and divide it by 25.6. And that's how much she has to take out for her second contribution. Excuse me, her second required distribution. All right, so when a 401k owner dies, you can read through here what happens. I'm not going to get into this, but it's using a different table. Notice it's table 1. Read through that. Take the time here and pause if you would like. Read through those. Look at the example. But I'm going to skip on now down to rollovers. 2 more sections here. We're going to look at rollovers and then finally the annuities. With the rollover, there's 2 types, and you always want to do the direct whenever absolutely possible. The direct transfer is the easiest, and you don't have to do anything, and they don't require you to take money out. The direct transfer just rolls it over from one retirement company, your retirement plan, into a different one. Basically, and that usually would happen if you quit your job and or you start a new job. The old retirement company may say, Now that you're no longer working at this particular firm, you can decide what you want to do with your money. And a lot of times you'll want to have a direct transfer and have it directly transferred from one company like TIAA CREF to the second company like the Hartford, and you tell them to do that. The not good way to do it is what is an indirect transfer, and that's where TIAA CREF sends you the money, and then you have to turn around and send it to the Hartford within 60 days. Now, just with that doesn't sound too bad. The bad part is TIAA CREF is going to assume, they have to assume, the government tells them that you will not roll it over, and they have to withhold 20%. So if you have 10,000, they're only going to give you 8. But then, okay, and you think, okay, well, I'll at least get it back when I file my taxes. That's true. But to avoid a penalty, you have to roll over the entire amount, not just what you receive, but the entire amount within 60 days. So you have to roll over the entire 10,000, even though you only have 8. You don't have the entire 10,000, so you're going to have to figure out, how am I going to get an extra 2,000 before my 60 days are up? And if you don't, then you would have that penalty, and that's just something you want to avoid. So therefore, just do the direct transfer. No money is withheld. All 10,000 goes right to the Hartford. Nothing you have to do. Nothing that shows up on the return. It's just all around simpler. All right, our final piece, the annuities. And this a lot of times is the hardest part of this whole chapter. With the annuities, you have 2 different types. You have a set annuity where you get money for a set amount of time. And then they have what's a lifetime annuity. And we want to look at the difference between the 2. The set amount of time, that's the easier one. It's the over a period of their life that makes it a little bit tougher. So an annuity, what it is, it's you pay up front a lump sum of money, and then in return, the company that you paid it to, some maybe insurance company, will pay you a set dollar amount over a specific amount of time or for your life. So perhaps you paid, let's make it real easy numbers. Perhaps you paid $1,000 on January 1. And then this company has agreed that they're going to pay you $100 for every month at the end of every month for this year. So if you do the math, you're going to get back 100 over 12 months. So you're going to get back 1,200. You paid 1,000 and you're going to end up with 1,200. It perhaps could benefit either you, because you get back a little bit more, or the initial company, because they're getting your money up front and able to invest it and potentially make more. So then we got to decide, and tax has to decide, how is that $100 that you receive taxed? You don't want to be taxed on the full 100, because a lot of that is your initial 1,000 just coming back to you. You only want to be taxed on the $200 of earnings. So how are you going to be taxed? What if it's split up over, you could say, well, that's easy, it's just $200 for November and December. Okay, but what if it's spread out over multiple years? Or even not even January to December? What if it's November to the next November? Would that mean that in that first year, you started getting $100 and another 100 that you wouldn't pay any tax? And the answer is no. You're going to have to prorate that $200 on a monthly basis. All right, let's see how that works. We'll come back to the lifetime in a second, but we're going to do the easier one first. So there's 2 things you have to do in an annuity. The first thing, you always have to find your expected return on an investment. How much are you going to get back? So in that little example, $100 a month for 12 months, my expected return was $1,200. All right, so let's do with some little bit bigger numbers over a longer period of time. So we put away $20,000, and we're going to get back $500 a month for the next 5 years. So the first thing I tell us we have to find, we know the amount of time. It's not per life, it's just a set amount for 5 years. So I know exactly how much I'm going to get back. 500 per month, 12 months in a year times 5 years. I'm out of the 20,000, I'm going to get back 30 over the 5 years. I'm going to come back to B in a little bit. So once we get number 1, then we come down here to number 2. Then we have to determine how much of what I'm getting back every month is not taxed. So all we do, it's pretty simple. Contract price, that's how much you paid up front, so $20,000. Divide it by how much you think you're going to get back, $30,000. So in this case, and what the answer here is, what is not taxed? 66.7% is not taxable on whatever you receive. So of the $500 that you get back, 60, so right here, of the 500, 333 of it is not taxed. Therefore, the remainder is taxed. So if you were looking at the end of the year document, you would take whatever's taxed on monthly basis for the 12 months. This would be how much is shown up on your tax documents. It would say a total distribution for the year would be, say, 500 times 12, which would be 6,000. Taxable would only be 2,000 though. So box 2, when you're looking at something like the annuity, which would be something like a 1099-R, 500 is the total, or 6,000 would be the total distribution, but only 2,000 is taxable. All right, so what if it's a lifetime though plan instead of just 5 years? What we have to do for the lifetime is use the tables, and these are a little bit more accurate tables instead of the generous tables that on table 3. Table 5 says, all right, this is how long we relatively actually expect you to live, just on average. So if we look at table 5 and somebody who is maybe 60 years old, they expect them to live another 24 years, which would be 84. That's pretty reasonable. Maybe a little bit on the high side, but not too bad. Especially for women. Men are a little bit less, but averaged out, that may be pretty close. So what we have to do is find the first thing we always have to find is the expected return. Well, you don't know how long you're going to live. You may live 5 years, you may live 25 years. So everybody has to use the same amount. That's why they have the chart here. So what we have to do is for that initial amount for the life, we have to say, okay, it's $500 a month, so $6,000 a year. And if that person was 50 years old, if you look up in the chart for 50, they're saying the person will live about another 33 years, so 83. 6,000 times 33, this person is going to expect to get back 198,000. Now notice the original investment is higher than my other one. My other one was only 20. This one is 120. And we get back 500 a month, but it's going to be for a lot longer period, for 33 years instead of just the 5. And that's why we have to use the tables, because with the lifetime, you don't know what your expected return would be because you don't know how long you're going to live. So 198.6 is our estimated expected return. Then we do the exclusion ratio. Same thing, we take the 120, actually here, 120 divided by the 198. 60% of whatever we receive is not taxed. So therefore, of the 6,000, 60% that's not taxed is 3,000. The remainder of the 6,000 is the 2,375. That would be how much is shown on your tax return at the end of the year. So 6,000 would be total distribution. 2,300 would be the amount that's taxable. One final note, if you did live past the 33 years, past that time if you were 83 years old, any amount that you received when you were 84 or 85 and continued, because it's a lifetime, all of it would be taxed. That's just because you've already then paid back. You've already received back your entire investment of 120. It's because you prorated it over 33 years. After that 33rd year, all of it is considered pure 100% income. So all of it is taxable. All right, let's look. Finally, what I want you to do is on example F and G, pause it. The first one, F, is the easier one where you have a set amount of time. G is the slightly harder one just because you got to use the charts. So pause them, and then for the final couple minutes, we'll go through the answers. So with F, Carol pays $200,000 up front. We need to determine how much is she going to be getting back based on $2,000 a month over 10 years. So that would be $2,000 times 12 months in a year times 10 years. So we do the math here, and it comes out to be $240,000. Again, that's not very good. That wouldn't be that great of a return because she's paying $200 up front and only getting back $240. So that means only 83% is not taxed. Whenever you're the actual person, you want this number to be as low as possible because that means you're getting more back. Up here, when I did the two examples in my notes, the second person, the lifetime person, was getting the better deal. 60% was not taxed. That means they were making more money compared to this individual, which was 66%. So not a huge difference, but it is a difference. So once we find out what's taxable, the 83% is not taxed. So that means the rest is. So when you look at the full 2,000, only a very little amount is left that's taxed. Spread that out over 12 months. This is the amount that would show up as taxable on their tax return. All right, the last one, part F. If you haven't already, go ahead and pause, and then we'll work through this one. So this 72-year-old is paying $50,000 up front for a lifetime annuity. She expects that hopefully she'll be living for quite some time and will get the most out of it. Now she's going to get back $800 a month. So if you just kind of do the math in your head, that's $9,600 a year. So hopefully to get her money back, she's got to live at least another 5 years, 5+. And then of course you want to make money. So hopefully she's thinking she'll live to at least 80 to be able to get a good return on her investment here. So let's see how the tax would break down. First thing that we have to do is find, remember step one is the expected return. So I already did this calculation for us. $800 a month times 12 months is $9,600 a year. And in the charts, if you look up a 72-year-old, it's expecting that they will live another 14.6 years. So that's quite a bit. That's a huge expected return. $140,000 if she would really live that long, that's 86. So that's kind of getting up there. $140,000 compared to the 50 initial. So therefore we can do the exclusion ratio. 50 initial divided by the expected return of 140. That leaves us with only 35% is considered not taxed. So the non-taxable portion every month is only $286. So if you do the difference then, 35 minus the 100%, that leaves 64% is actually taxable. 800 times what's taxable percentage, 514 a month times 12 months. This is what she would have on her tax document as taxable. The full 9,600 would be the total distribution. This would be the full amount that's actually taxable. With that, we end this week. There's not a whole lot this week that is due. There's no tax return or discussion board. It's a little bit more complex of a week. Therefore, we have a little bit less. We just have our normal weekly end of the chapter questions. With that, we will end it here, and we'll go next week. And we actually have 2 weeks next week when we have our own business.